I'm Jim Gilstrap. I'm a licensed insurance counselor, and I enjoy working with insurance professionals to help them learn more about the products that they offer to the consumers. In this video, I'd like to talk a little bit about the universal life insurance policy and the features that it has. This video is designed mainly for individuals who are new to the insurance industry or for those who are unfamiliar with how the universal life policy works. If you're a consumer watching this video, trying to learn more about the product before you make a purchase, hopefully I'll be able to answer some questions on that as well. Now, the universal life policy can seem like a complex account, a complex policy, because it does have cash value built into the account. Now, the way the policy is structured is it's essentially a term policy that has a cash value account, and the purpose of the cash value account is to sustain the coverage later in a policyholder's life. I'll show you some slides in a few moments that will help illustrate that point. But for right now, I also want to talk about the premium and how that cash value can go up or down depending upon how much premium the policyholder is willing to contribute to the policy, and also the cash value account growth depends upon what the interest rate is that the insurance companies are offering. Now, the interest rates are not necessarily tied to market conditions, but they are also tied into the company's performance. So some insurance companies can offer a better interest rate than other insurance companies depending upon how well their policies are performing. So if you're a consumer, you need to shop around. Perhaps you could find a company that has the best interest rate at the time. And if you're an insurance agent, look at your companies and find out what they are before offering this product to consumers. Now, a lot of insurance agents will try to tell me that the universal life policy is a good investment option. And I have to remind them that under the Investment Advisors Act of 1940, it is illegal to offer any life insurance policy as an investment tool. It cannot be offered as an investment product. Now, with that said, a universal life policy is a great supplement to an individual's investment portfolio, because with a life insurance policy, they can protect the investments that they're earning over their lifetime. So if the individual passes away before the portfolio has a chance to grow, then it will provide money for his or her family without having to wait for the investments to come to fruition. So it cannot be offered as an investment product, but it's a good supplement to an investment portfolio. Now, as I mentioned a moment ago, the universal life policy is essentially a term policy with a cash value account. So let's back up a moment and review how a term policy works. In this case, we've got an individual that's 30 years old wanting to buy a term life insurance policy. Many insurance companies offer a term policy at 10, 20, or 30-year increments. In this particular example, we're going to look at a term policy that is to age 70. A lot of companies can also offer what's called a term to 70 policy, meaning no matter what age the individual purchases this policy, the coverage is designed to last until age 70. In this scenario, we've got a relatively healthy lady who's purchasing a policy, and she's 30 years old. Now, what are the chances that she's going to live beyond age 70? Well, they're very good, especially with the advances of modern medicine over the next 40 years. I'm sure she's going to have a good chance, possibly even to reach 100 years old. So when she reaches age 70 under this term to 70 policy, what's going to happen to the account? Well, the account will cancel and it will go away unless something else happens and she wants to continue coverage. Because she may reach age 70 and decide that she still has debts or assets to protect. Perhaps she doesn't want to leave a burden to her loved ones with burial expenses. So she wants to continue coverage beyond age 70. Many insurance companies on their term policies will also allow this option to purchase additional coverage beyond the term, but they'll let the client buy them at 1-year intervals. Now, at age 70, her premiums are going to begin to go up and up and up because she's getting older and more likely to pass away during the policy period. So the insurance company is going to charge a little bit more premium each year. And by the time she's in her 80s, 85 years old, this premium is going to be very, very expensive to continue this coverage. So more than likely, a person who's a senior citizen living on their retirement investments, they probably won't be willing to pay the premium, and they'll stop paying. And at some point, when she stops paying the premium, the coverage is likely to drop before she does. Now, to counter this, insurance companies developed a universal life policy. In this case, the universal life policy is projected to go to age 100. Many companies might offer a universal life to age 80. They may offer a universal life projected to age 90. They might even project it to age 120 because now the mortality tables are projected to go to age 120. In our scenario, we're looking at age 100. I'm going to leave the term premium here as a comparison, but the universal life premium is going to be a little more than the term policy. And there's 3 items where the premium is applied on the universal life premium. The first one is the cost of the insurance. That's the premium the client's going to have to pay to age 100 to pay for the insurance provided by the policy. The second item is fees that are associated with the policy. There are many factors that go into underwriting the account, such as urinalysis, blood samples. The client may have to take an EKG. Anything that can determine the health of the individual, the company's going to look at, and it's going to be taken out in the form of fees. Agent commissions are also associated with the fees and underwriting expenses. The third component of the premium is the cash value account. As the individual pays more premium, the extra premium after the cost of insurance and fees, the extra premium above that will go into the cash value account. So if we represent it by this arrow on the chart here, it begins to grow slowly at first. The separate cash value account begins to grow slowly. And if you look at an agent's policy illustration when at the time of purchase, it makes a straight line because the insurance company bases those rates, the cash value growth, based on current interest rates. And it may be 4.5%. And they'll project that out over the life of the policy. Unfortunately, you and I know that interest rates don't always stay level, especially when you're looking at 40, 50 years down the road. So in a real-life scenario, when you look back on a policy, you'll see that the cash value fluctuates up or down, doesn't stay that same straight line. This is because the insurance rates within the policy might fluctuate up or down, again, depending upon the company's performance. Now, there's also an option where the client can overfund their universal life policy, have that cash value grow faster in the early years. The purpose of that is they might have to pay less premium later on in the policy period. We'll talk about that as we get this chart fully set up. But they can also underfund the account, not have enough premium there in the account, and the policy might be in danger of lapsing before it reaches age 100. So we need to counsel our clients to make sure that they properly fund the accounts. In this case, we're going to look at a straight target premium account. Now, as the client reaches age 70 and the cost of the insurance begins to go up and up and up, at some point, the cost of the insurance is going to begin to exceed the premium they're paying. There's a shortfall to sustain the policy. Where does that shortfall come from? It comes from the cash value account. The company will begin to self-surrender some of the cash out of that account to make up the difference in the increasing cost of the insurance and the amount needed to sustain the policy. So over the life of this client, life of the insured, as they get into their 80s and 90s, the cash value will drain much faster. And at some point, with the targeted premium lasting to age 100, the policy account cash value will zero out and they'll have coverage lasting until age 100. And that was the purpose. So this is a pure target premium account. If the client were to overfund this account, these cash value account would grow faster in the early years, and they would have a lot more cash value at the peak when the premium, or when the cost of insurance exceeds the premium, and therefore they could begin paying less later in life, to help the policy sustain. So that's one purpose for overfunding an account. Now, with the interest rates as low as they are now, it's a great time to be looking at a universal life insurance policy, because if you're an optimist like me, 10, 15 years down the road, hopefully the interest rates will rise and the policy will overfund itself. And even if you're a pessimist, with the interest rates as low as they are, they can't get much lower, and with proper advising to the client, you can ask them to put 10 or 15% more into the policy in the early years, just in case interest rates do fall. So that's how a universal life account is structured. and how the cash value account is used to sustain the life insurance coverage through to the age 100 in our example. Again, that might be age 90 in some companies, age 120 in other companies. Now let's look at a real situation here. I recently contacted my insurance agent and asked them to run a life insurance illustration for me. I'm in my late 40s and I wanted to see how the cash value account might project out to age 100. So by age 50, it's just barely starting to grow. 55, 65, going on up towards 70, it grows at a steady pace. Somewhere between age 75 and 80, the cost of the insurance begins to exceed the premium that I'd be paying, and the company will begin to surrender the cash value back to make up the shortfall. So as I get into my 80s and 90s, closer to 100, I'm more likely to pass away before I reach 100, and therefore the cost of insurance skyrockets and the cash value account is drained away rapidly. Now at any point during this time frame, I could surrender this policy and take the cash value, but I would lose the death benefit. I could also take policy loans against that cash value. Those are my options. And again, if you're looking at surrendering a universal life policy or taking some cash out of a universal life policy, it's imperative to talk to the agent to find out if that's in the proper interest. Now, before we leave the mechanics of the universal life policy, I want to also talk about the death benefit options that are available. The first death benefit option is called a level death benefit. In this scenario, the individual purchased a life insurance policy for $200,000. So if they pass away at any point while the policy is in force, their beneficiaries will receive a $200,000 tax-free cash payout. Now, the cash value also grows within the policy, and many consumers might ask the question, well, what happens to the cash? If that's my money, where does it go? Well, on a level death benefit option, the insurance company retains the cash value. A lot of consumers don't see the value in that. They say, well, if it's my money, I don't want the company to get it back. Why can't my beneficiaries have it? So insurance companies developed a second option. They said, okay, we'll continue to have this $200,000 level death benefit payout, but as your cash value grows, so will your death benefit. So in addition to paying the $200,000 face value death benefit, they'll also pay the beneficiaries whatever cash value is left in that account as well. Now, the drawback to that is, of course, if the company is on the hook to pay out more in the death claim, the client is more likely to pay more premium on the account as well. So that's the trade-off. Well, that ends my program for the Universal Life, and hopefully I've explained some of these basics. And if you have any other questions, please consult your insurance advisor. Thank you, and good luck on your careers.